to answer questions and explain in more detail. The Federal Open Market Committee this afternoon reaffirmed the current 0 to 1/4% target range for the federal funds rate. We also updated our forward guidance indicating that an increase in the target range for the federal funds rate remains unlikely at our next meeting in April. What is fundamentally a disappointment is with continued improvement in economic conditions, however, we do not want to rule out the possibility that an increase in the target range could be warranted at subsequent meetings where they think that that's appropriate. In some situations, just because we remove the word patient from the statement doesn't mean we're going to be impatient. That's something that we will, look for. At the end of this year, the central tendency for the unemployment rate stands at 5 to 5.2%, in line with participants' estimates of the longer-run normal unemployment rate.
Maturing, and there might be a spike in long-term interest rates that maybe you would.
After averaging about 2.5% over 2014, growth of real gross domestic product appears to have slowed in the first quarter of this year, in part reflecting a moderation in household spending. In addition, the recovery in the housing sector remains subdued, and export growth looks to have weakened. Concerning the structure of incentive pay, and inflation has declined further below our longer-run objective, largely reflecting the lower energy prices I just mentioned. Declining import prices have also restrained inflation, and in light of the recent appreciation of the dollar, will likely continue to do so in the months ahead.
Prove it, and when?
FOMC participants project inflation to be quite low this year, largely reflecting lower energy and import prices. The central tendency of the inflation projections for this year is now below 1%. Cease reinvestments or diminish the pace